Time for Ask Annex. As always, get a question for us. You head to our website, annexwealth.com. You look for the Ask tab. In the studio, Matt Morzy, investment team manager. Welcome.
Hey, Danny.
CFP, too. I always forget that.
Yes, sir.
That was hard-earned, wasn't it?
It was.
Fred Coleman, CFP and a wealth manager at Annex Wealth Management. Welcome to you.
Yeah, thanks for having me, Danny.
Question number one on Ask Annex. Assuming Social Security is stable, how does Roth and HSA savings affect the amount of Social Security one will receive each month, and assuming 30 years of Social Security income? Because these will reduce the amount of Social Security received, and that Roth may be a wash to traditional 401ks or IRAs. Are they really getting me ahead? No one has ever covered this math that I know.
Yeah, that's a great question, and there's a lot of math involved. And luckily, with all these moving parts when it comes to taxes and rules and all these different laws that change, it's almost impossible to figure out. But fortunately, we have the tools, the systems, and the people here that helps even us figure those types of things out. So when it comes to HSA contributions, they're not included in Social Security wages. So making HSA contributions, it can slightly reduce what's called the Social Security wage base. On the other hand, it saves that 6.2% on what's called FICA tax. You get a tax deduction for the income. It grows tax deferred, and you have the opportunity to withdraw tax-free in the future if used for medical expenses. So I think the benefits of contributing to a HSA far outweigh the small additional benefit of counting that income towards your Social Security. 401ks and Roths, they're both included in the Social Security wage calculations. So that won't affect your benefits at all, making contributions to those. With all that being said, it's important to put the numbers to the test in a financial plan and to see what's the optimal amount to contribute to these various types of accounts.
The segment is called Ask Annex, but it's also a soapbox as well because I love this one. Here we go. This is more of a rant and less of a question. My nephew is complaining about his weak performance in a 2055 target date fund that is 90% equity. Market has been roughed up recently. He's 30 and should know better. I keep my mouth shut. Why aren't schools teaching investing basics?
Yeah, it's a lot to unpack there. I think investing should be a part of the curriculum as well, like math and reading and all those subjects that we learn in school. But that's what we're here for. We lead with education here at Annex. The thing about the target date fund that I like, if you don't work with an advisor, they make them really easy to understand. The objective of the fund is that you're planning on needing the funds around 2055. So by investing in this fund, you're playing the long game. You got about 30 years. Volatility is going to be expected. I look at it as an opportunity to buy low. Today's markets could be the lowest markets that he'll ever experience in his life. So my advice is look at this as an opportunity.
Yeah, I completely agree. Oh, go ahead, Dan.
No, Matt, if it's 90% equities, isn't it bound to be pretty volatile?
It's going to be all over the place, that's for sure. We're coming off a couple of years here where the market's been all over the place. Even the 10% of that's fixed income, we're in a really, really long bear market for fixed income, so that's not helping as well. And especially depending on how they've invested that fixed income, if they've used longer dated treasuries or longer dated bonds, they're going to be feeling that pain even more. But Fred, as you were saying, it's really an opportunity. And with that much time to go, you really want to see a lot of volatility if you're younger. Frankly, you really want to see a pullback, and you want to be able to get as much money into that target date fund as possible and allow that to grow over time. So with 30 years out, to get to that spot, you do actually want to feel bad about it today, so you feel better about it going forward. And from an education standpoint, I was always kind of amazed too growing up that there wasn't a lot of financial classes in school. Even when I went to college, I took one financial planning course that it was an elective that I did as an independent study because my school didn't have a major on it or classes. I went back and taught the same class later on to undergraduate kids, and I had 6 kids who signed up for that class. So it wasn't a lot of kids that were really looking for it, but it's so, so important, and it's one of those things that people don't know nearly enough. So I love here, like you said, that we lead with education with our clients, and it's something we really believe strongly in.
And, sir, if we may give you permission, since he is your nephew, you can yell at him. Right, you can. Last question on Ask Annex. How does someone become an accredited investor? And before you answer that, what is it and when do you have to be one?
Yeah, that's a great question. And it really comes down to specific types of investments are available for everybody. Think individual stocks, individual bonds, mutual funds, ETFs, stuff like that. Yeah, anyone is able to go in and invest in those things. But there are certain things that don't have the same level of regulation regulation or don't have the same level of rules, that the SEC has decided that if you want to invest in these, you have to hit certain requirements because of that extra complexity and some less protections that are around you. And there's a couple different levels to this, but the one particular here is an accredited investor. And the definition is that you need to either have an income of $200,000, or if you're married, $300,000 combined, or you need a net worth of $1 million or more, and that's going to exclude your primary residence, and it has to be consistent or somewhat consistent too. So it's not just a date and time or one time you have to hit one of those things, but be able to show that that is stable. And the reason there is that the SEC is assuming that if you have a higher income or a higher net worth, that one, you could take the risk of being in something like a hedge fund, private equity, private real estate, venture capital, things like that, or that you have a higher sophistication level that you can understand the ins and outs of there. And that may not be true, so that's one thing that you got to watch for. Just because you have a high income or high net worth doesn't mean that is the right thing for you, but they're assuming that it might be a better placement for you because you might understand a little bit more. Now, keep in mind, a lot of those things have higher fees as well, too. A lot of those things go together, but it's one dividing line that the SEC has said is out there.
Matt Morzy, CFP, Investment Team Manager, thank you.
Thank you.
Fred Coleman, CFP, Wealth Manager, Annex Wealth Management, thank you.
Thanks, Danny.